Hi, welcome back. In this session, I'd like to talk about my fifth data update to my 2018 data. And I'd like to talk about another backlash from globalization that we all feel when we value companies. 25 or 30 years ago, if you're asked to value a company, not only could you work with it in the local currency, which was our topic for the last post, you could just think about risk in your country. So Indian companies tended to get most of their business in India. You could use the Indian risk premium. Brazilian companies got most of their revenues in Brazil. You could use the Brazilian risk premium. And US companies, for the most part, barring a few multinationals, got most of their business in the US, and all you cared about was the US equity risk premium. So if you lived and worked in a developed market, I can see why you might not have cared what emerging market premiums look like. That is no longer the case. In fact, I'm going to start this session by stating what I think are two unexceptional facts. The first is that risk varies across the world. That the type of return I, as Coca-Cola, would demand for investing in a project will be far greater if that project is set in Serbia than if it is in Germany. So country risk varies across countries. I have to somehow bring it into my analysis. Here's my second statement about country risk, and you tell me whether it's exceptional or controversial. A company's risk doesn't come from where it's incorporated in trades. It comes from where it does business. So you could have a company like Coca-Cola, which is a US company in terms of incorporation and trading, but it gets its revenues from all over the world. I would argue that when I value Coca-Cola, I should be looking at where it operates, not where it's incorporated in trade. You would think that these two statements would not be controversial, but for some reason, there's still debate about whether risk premiums vary across countries and whether you should be using risk premiums reflecting operations. I don't see the place for that debate, but maybe that debate has to go through a phase before people come to that conclusion. So in this session, I'd like to talk about measuring the risk in countries. Now, if you think about measuring risk measures, the risk measures that are most commonly accessible, more easily available, are sovereign default risk measures. We talked a little bit about one of them in the last session when I talked about currencies, and that is sovereign ratings. And those sovereign ratings, if you look at Moody's, S&P, or Fitch, usually you have a local currency rating or a foreign currency rating. The foreign currency rating, of course, measures the risk to the country when it borrows in the foreign currency, and the local currency rating is the rating that measures the default risk in that country when it borrows in the local currency. Now, of course, those ratings can be different across different ratings agencies, but for the most part, the ratings agencies tend to agree on what the safest and riskiest parts of the world are. In this picture, for instance, I have the January 2018 ratings agency view of the world. The green parts of the world are the safest parts of the world, the triple A's, the double A's. And as you move away from the triple B's to the double B's and down to the C's, you see the world go from green to yellow to red. Now, not surprisingly, the riskiest parts of the world, at least according to ratings agencies, are Africa and South America. And you can add on Eastern Europe, even though there aren't particularly red parts there, it's still a pretty risky part of the world. The safest parts of the world, according to the ratings agencies, are North America, much of Europe, especially Northern Europe, and Australia. And you can see China is starting to slip from the risky country column to the safer country column. So if nothing else, this is how ratings agencies see default risk around the world. Now, we of course have talked about the limitations of ratings agencies that say sometimes mess up and that they're often late to the party. So the alternative measure of country risk is to let the market tell us how much default risk there is in that country. And that's of course what a sovereign CDS spread gives you. A sovereign CDS spread, as we mentioned in the last session, is insurance against default risk. So you can think of it as the default spread set by the market as opposed to the ratings agency. Now, unlike ratings, which are available for 140 countries plus, sovereign CDS spreads are available for only about 65, 70 countries. And in this table, I've captured the sovereign CDS spreads for different countries with the start of the year numbers for these CDS. I've also computed in the second column a net number. You're saying net of what? Well, if you look at the sovereign CDS spreads, there are no countries with zero spreads. Notice that? Even the safest countries like Switzerland, the US, and Germany end up with some spread. You're saying, what does that even mean? Well, part of the problem for that is the sovereign CDS market is a market where you still have counterparty risk. You're not exactly buying full insurance. There's uncertainty about the insurance. So even safe countries will end up with some spread. You're saying, what do I do then if I wanted pure default spread? Well, I've done something very simplistic. I've assumed that the default spread for the US is a rough measure of the friction in the market, of all those counterparty risks and the other risks you could not eliminate. And I'm going to net the US spread against the country spread to come up with a net spread. So think of this also as a measure of default risk, but coming from the market. So two measures of default risk, one a ratings agency rating and the other a CDS spread. But let's face it, we're not interested just in sovereign bonds. In fact, I'm not interested at all in sovereign bond default. What I'm interested in is equity risk. And default risk might be too narrow a way of thinking about equity risk because default risk first is to the sovereign and it's focused on one type of risk. So I expanded the measures of risk to bring in different measures. One is, of course, a risk score. There are a bunch of agencies out there that measure country risk with a score. The Economist does it, the World Bank does it, and one of my favorites, Political Risk Services, does it. The scores are not comparable across agencies. They, in fact, some go low to high, where low scores are safe countries and high scores are risky countries, and others go high to low, where high scores are safe countries and low scores are risky countries. But that's okay. You still have a measure of risk that tries to capture more than default risk. The reason I like PRS is they're pretty transparent about what they bring into the score. They look at everything, political risk, legal risk, and they come up with a composite risk measure. Before I show you what the numbers look like, a couple of things about the PRS score. High numbers in the PRS score suggest safe countries. The safest countries have the highest scores, and the riskiest countries have the lowest scores. And PRS revisits those scores. And the score you're going to see is a composite risk score. This is a score that captures all of the different kinds of risks that PRS looks at. In fact, they have individual political risk scores, legal risk scores. This is the composite risk score. So let's see, based on the risk score, what the world looks like. And what you notice is a lot of overlap with what the ratings agencies saw, right? Just as with the default spread and with the ratings, you notice that the riskiest parts of the world are Africa, South America, and Eastern Europe. The safest parts of the world are North America, Northern Europe, most of Europe, and Australia. China again falls in the middle, but now India, if you look at PRS scores, is becoming closer to a safer country than a riskier country. Again, a different measure of risk, a more composite measure of risk. I'm still not there, right? You're saying, what do you mean? I want a risk premium, a percentage number. So here's my final stop. I'm going to try to compute an equity risk premium, and I do at the start of every year. This is among the most downloaded data sets on my website, and I'm going to tell you what the weaknesses are as well. It's a strange thing to do for somebody who reports these numbers. But let me take you through the process of how I estimate equity risk premiums for individual countries. I start by estimating an equity risk premium for the US. You're saying, that is so parochial. Hey, guilty as charged, but I'll tell you why I use the US. I have an index, the S&P 500, that I understand. It is a large index, so unlike other markets like the Nikkei and the DAX, where you have narrow indices, I have a big index that I understand. I compute the implied equity risk premium for the S&P 500. So if you back a few sessions, I gave you the update for this. At the start of 2018, the equity risk premium for the S&P 500 is 5.08%. That's my first stop. Now here's what I'm going to do. I'm going to assume that if you're a mature market, your equity risk premium has to be roughly 5.08%. Why? Because if your premium were lower, money would leave your market and come into the US. And if your premium were higher, money would leave the US and come into your market until premiums equalized. I know that might be a stretch, but essentially all mature markets should get a 5.08% premium. You're saying, how do you come up with mature markets? Well, I cheated. I looked at the ratings agency's rating, and if you got a AAA rating, and I know this is not quite kosher, but I'm going to go with it, I'm going to give you a mature market premium. So countries like Canada and Australia and the Netherlands and Germany are going to get 5.08% premium. So you're saying, well, what will happen if I don't have a AAA rating? My work's laid out for me. Here's what I do. I take your sovereign rating, I convert it to a default spread. In fact, I gave you the table for default spreads in my last session on currency risk-free rates. So if I know your rating as a country, I get you default spreads. If you remember for Nigeria, with a B1 rating, I gave them a default spread of 5.64%. So basically, if I know your rating as a country, I look up the default spread for your country. But then I don't stop there. I make the argument that equity risk premiums should be higher than default spreads. Why? Because the equity guy is last guy in line. Now, the way I do it for individual countries is I go looking for the two standard deviations. One would be the standard deviation in the equity index in that country, and the other would be the standard deviation of the government bond issued by the country, and I compute a ratio. So as an example, if your standard deviation in the Bovespa is 21% and the standard deviation in the Brazilian government bond is 14%, I would make the argument that Brazilian equities are 1.5 times more equity than the Brazilian government bond and multiply Brazil's default spread by 1.5. Well, the problem with that approach, though, is you need traded government bonds and you need a measure of volatility that you can actually trust. And as we noted in the last session, finding government bonds is tough to do in many countries. And even if you find a government bond, it's usually not traded. You can't look up the standard deviation number. So here again, I'm going to adopt an approximation. I looked up two standard deviations, but rather than look up individual countries, these were both indices. One was an index of emerging market equities. It's an S&P index. And I looked up the standard deviation in that number over 5 years using weekly returns. Then I looked up the standard deviation in an emerging market government bond index, another I think it's an S&P index. In fact, or perhaps it's a Merrill Lynch index. But it's an index that looks at government bonds from emerging markets and looks at their standard deviation. Again, I looked at 5 years of weekly returns. So both are 5 years of weekly returns, both are standard deviations. Incidentally, for the government bond, I actually just had the yield, so I had to do a little finessing, but I ultimately ended up coming up with a ratio of 1.12. You're saying, what is that? On average, looking at these two indices, it looks like emerging market equities are about 1.12 times risky as the government bond. I apply that multiplier to all the default spreads. What that gives me is the additional country risk premium for a country. I add that on to my 5.08%. I get the equity risk premium for your country. This takes care of 147 countries. But there are about 20 countries for which I could not get a sovereign rating. Why? Because these are frontier markets. Markets so risky, even the ratings agencies don't want to go in there. Markets like Syria and North Korea. You're saying, what do you do with those? Until a few years ago, I used to ignore them, but I do something to try to bring them into my sample. Here's what I do. I look up those PRS scores. Remember we talked about them for those countries. And PRS actually has risk scores for Syria and North Korea. Then I try to find other countries with similar risk scores for which there is a rating, a default spread, and an equity risk premium I've estimated. So let's say I find 3 other countries which have risk scores close to Syria. You know what I'm going to do, right? I take the average equity risk premiums across those countries and apply it to Syria. You're saying that is so approximate. You're right. Again, guilty as charged. If you can come up with a better way of estimating risk premiums for these markets, I'd love to hear them. So here's what the world looks like from an equity risk premium perspective. So notice I start at 5.08%. That's my mature market premium, computed using the S&P 500's implied premium. So all those really green sections are 5.08%. Then you have countries which are mildly risky. AA2. And remember, the riskier comes from the ratings agencies. So if your rating is AA, even single A, you're going to see a risk premium that's relatively low because I take the 5.08% and I go through the process that I just described. And then, of course, you have the risky parts of the world. And again, no surprises, right? The riskiest parts of the world are in South America and Africa. Eastern Europe doesn't look as bad on an equity risk premium perspective. On a default risk perspective, it might look worse. On a PRS score, that might look worse. But in an equity risk perspective, it doesn't look as bad. So that is my picture of the world. And of course, it's kind of tough for you to read this in the map. It's a heat map. It just shows you what's high, what's low. So if you prefer numbers, this is the way I usually use it in my presentations, where you can see the world broken down. And you'll see 3 numbers reported for every country. You'll see the rating for that country. You'll also see the black number is the equity risk premium. That's what I would use for that country. And the red number is the country risk premium that I added to 5.08%. So that number is going to be zero for all AAA rated countries. And as your rating drops, that number is going to increase. And towards the right top corner, you actually see my frontier markets, where I use your PRS score to estimate what your risk premium should be. That's the world as it looks to me at the start of 2018. So that's what I wanted to say about country equity risk premiums. Now it's turned to company equity risk premiums. So what's the difference? As I said at the start of the session, to me, a company's risk does not come from where it's incorporated and traded, but from where it does business. I am surprised at how many company valuations I see that seem to disagree with me on this one. But if you adopt my perspective, to measure the equity risk premium for a company, I need to know where its operations are, both where it produces stuff and where it sells stuff. And then I'm going to make a judgment call. If I think your risk comes from where you sell stuff, I'm going to take a weighted average equity risk premium based on where your revenues come from. So if you're a consumer product company, that's what I'm going to do. So for Coca-Cola, the equity risk premium will be a weighted average of the equity risk premiums of the countries they sell Coca-Cola in. If you're a company where I feel that the bulk of your risk comes from where you produce your goods and services, I'm going to weight your equity risk premium by where you do production. So for Royal Dutch, an oil company, where I think the risk comes from where you get your oil, not where you sell it, I'm going to use a weighted average risk premium of the countries where Royal Dutch gets its oil in or has its reserves in. And if you feel in your company both matter, nothing stops you from using both and coming up with a weighted premium. As I said in valuation, it's about first principles, not going back to some equation that's rigid and doesn't change from company to company. Here are three implications that emerge from taking this particular view of the world. The first is a company cannot change its risk profile by just changing its listing. So I remember maybe more than a decade ago, South African mining companies deciding to delist in South Africa and relist in the UK. And I remember talking to the CEO of one of these companies and asking him, why do you do this? And here's what he said. He said, well, I wanted to get less risky. I said, it's that easy. Just change your listing. Aren't your mines still in South Africa? So maybe there are some people in the market who get fooled by it. But from my perspective, from an intrinsic value standpoint, just because you're listed in London makes no difference. I'm still going to value the same way you did before. Now, of course, when you relist, you might get different tax. So if there are tax effects, we can talk about the effect on cash flows, but don't tell me you're less risky just because you relisted somewhere else. The second is the equity risk premium I use for a company should reflect its geographic mix, right? Let's face it, geographic mixes change over time. You could have a developed market company that decides to go heavily into emerging markets over the next 10 years. You're saying, so what? Your weights could change on countries could change over time, and as it does, your equity risk premium should also change. And finally, and this is a corporate finance implication, if you're a multinational investing in different parts of the world, there is zero chance, none, that you can use the same hurdle rate around the world, same cost of capital, even if you're doing everything in the same currency. So if you're a multinational, let's say Coca-Cola, the cost of equity and capital you use for a project that you take in Brazil should be a lot higher than the cost of equity and capital for a project you take in Canada, even if they're both in the same beverage business and they're both in US dollars. So to me, these seem like common sense implications, but you're welcome to disagree. So in conclusion, I often use the Chinese symbol for risk in my corporate finance and valuation classes, and I'm constantly taken to the woodshed saying it's not true, but whatever it is, it makes for such good talk. It's such a good talking point, and I'm going to stick with it. The Chinese symbol for crisis or big risk supposedly is the combination of two symbols, danger plus opportunity. Okay? And if you buy into that symbol, to get opportunity, you got to get exposed to danger. That's the way I think about globalization. No US company wakes up and says, I want to be in Mongolia or Myanmar. They go there because they feel that that's where the growth is. And that is, I think that's a good idea. But all we're doing here is saying, if you go to Myanmar or Mongolia, that's fine. You're going for the growth opportunities. Just remember, that investment is going to come with a lot more risk. And the prudent thing to do is to adjust your discount rate for that additional risk upfront rather than moaning about it after it goes bad. And I hope in this session I've given you my perspective on both why equity risk premiums vary across companies and why, when you value a company, you need to do your homework and find out where the company does its business. And I hope the accounting rule writers recognize that this is the disclosure that they should be working on, not the pittances and the minor stuff that they keep loading up into financial statements. Because this I need to know as an investor. Where do you get your revenues? Where do you produce your goods? I hope you've enjoyed this session. Thank you very much for listening.